So we're going to do another workshop. We're obviously, as you can tell, if you're a regular listener of Ron Siegel Radio, and we appreciate you. If you are, we never take for granted that you have many, many options. But if you're a regular listener, you know that we generally have a format that we follow. But today we're doing things a little bit different because, well, every once in a while we just get an opportunity comes along for us to share some really great information. We have Todd Halterman with us this morning. PCP Consulting, and he's in the last segment. If you missed it, you missed a ton. He shared with us how Joe could get out of debt instead of his 27.8-year trajectory to under 7 years without spending any extra money. You missed it. But now we're talking because Joe was a business owner, and Joe's situation. He's a business owner in that segment, but it doesn't only apply to business owners. It applies to anybody. It applies to you, maybe. But how about a small business owner? Now they're thinking about succession planning. You own your own business. Maybe you've got a contracting company. Maybe you've got a machine shop, catering company, restaurant, any of the above. And maybe you've got some idea about retiring at some point in the future. So take it away, Todd. Talk about this one. We've got another case study here. And I'm going to let Todd take this one because he's the guru of disinheriting the IRS.
You bet. Around the country, real estate values are way up. Business values are way up. It's interesting to see what's happening where a lot of people are positioning themselves to sell real estate or to sell their businesses or highly appreciated assets. Some folks just have stocks who've gone up so much they don't know where to start on how to take those down without getting their head ripped off in taxes, especially Californians that they end up in the 53% tax rate at some point when they have a large capital gain that they've got to realize. So,
well, look at that, Todd, because just to interrupt you real quick, look what happened just today. When you don't think that policies and laws and things affect people, and I don't know the exact issue, but the CEO of Microsoft sold half of his Microsoft holdings. It was announced today. And the speculation is that January 1st, there is a 7% capital gain tax going into effect in the state of Washington. I don't know what state the CEO lives in. Microsoft is based out of Washington. Do you think that had some effect on his decision-making? He probably can afford to pay a lot of really good, smart people to advise him on when to sell. So go ahead, Todd. I'm sorry.
Yeah, and that's the case, and that's not unique today in many states. So for business owners who've taken all the risk, real estate buyers and investors who've taken all that risk and over time been able to benefit from having that risk, now they're going to give 1/3 to 1/2 of those profits back to the governments to support this fiscal policies that they obviously believe in, which aren't sound. They're debt strategies, and these taxes are going to help bail them out. Taxes are voluntary, Ron. So if they're voluntary, there's got to be a way for people to do it better. And that's what the Alpha 3 Tax Guard process is. Our process is designed to help people not pay taxes at closing when they sell their business or real estate. This process is designed to help people not pay capital gains or ordinary income tax when they close on their property or business. How many Americans would like to not pay taxes at closing when they sell, Ron?
That's only the rich and famous. I mean, we hear about Donald Trump not paying any taxes, and we hear about Elon Musk. He tweeted out the other day about that, the government's after him because he doesn't pay taxes, supposedly, and he tells us about how many billions he is. But I think, those guys, they pay a lot of great people to give them advice. I don't think they're breaking the law. You tell me, Todd. I mean, I'm sure that they're doing things strictly by the book. They just know what the book says.
Well, and honestly, they take the time to do real planning, and they have planning advisors around them. They have a legal officer. They have a tax officer or two. They have a financial officer. They have a board of directors. They have industry experts. They actually have their board of advisors. And what most American families make the mistake of is they try to be the expert in legal, marketing, tax, in their business and industry, finance. They try to do it all, and you can't be an expert of it all. So they say the rich get richer. The rich get more advice. The rich have advisors that help them make sound decisions. But in this system, the Alpha 3 tax guard process, it's to mitigate taxes, defer them, or eliminate them altogether. Now, not everybody qualifies to not pay taxes at closing, but what we do is we enter programs in 3 different ways to help them pay no tax at closing or very little as possible, with over 90-year-old tax laws that have not been used widely across America for many reasons, but we're using them in our tax guard process.
Love that idea. So let's look at this case study. We got an IT consulting firm, and they actually decided to go. They made the decision to sell. So they're obviously they're a little bit different than what I see in many entrepreneurial companies. They've got a long-term plan, so they know what they want to do. They've come to talk to you 4 years before they are looking to sell their business. And we have business brokers that are part of the Ron Siegel Radio team here as well. But let's take a look at this one. So we've got the 4 years ahead of time. They come and talk to the Alpha 3 tax guard team. That doesn't mean they're getting rid of their CPA. They're still consulting with their own CPA.
No, we work directly with their attorneys and their accountants who they've used for years. We don't ever want to disrupt those relationships. We want to complement them with specialists in this area.
So they've got a couple kids, and they're going to tell us about this strategy, Todd. We've got a few minutes here. We've got about 4 minutes to go through it.
This family set up a Nevada-based trust a couple years prior to them looking at wanting to do a succession plan. And we taught them how they could actually gift part of the shares of their company away to their children, to help reduce, obviously, their ownership basis, but that also creates a gift to help shift taxation as they age and, of course, when they pass away. So the first thing we do is we have gifting strategies that simply help families build a family corporate structure early. Don't wait till you're dead for families to build the corporate structure. That's when you'll pay the most tax. So we simply help families build family corporate structure ahead of time to help them manage the tax liabilities and control when they pay those taxes, not be out of control. So, and basically this was done 4 years prior to when they actually sold the business. So these gifts brought down mom and dad's ownership basis. So income was earned on the children's tax rates, and the children shares escaped the California income tax. Well, obviously, because we did this way before the transaction of the sale. So in 2017, Mary and John sold 60% of the business, is what they owned at that point in time, because they had gifted away shares to the children, and they sold it for about $13 a share. So during that time, the children's portion grew to over $7.8 million as the value of this company grew. And that helped the parents, again, reduce and eliminate future taxes, because obviously the kids are at a lower tax basis. So basically, long story short, we saved over $800,000 of capital gains tax in California just from a gifting strategy and building corporate structure for the family business and a succession plan, Ron. So that's the initial piece of this puzzle. So the tax guard process isn't as simple as just setting up a simple trust. There's more in line, and we want to do it the least expensive way possible. And then what happens is when we build these trusts to hold capital, then the family that sells the business can decide when the money comes out of their trust to live on or to redeploy into another business or property. But they decide when they use that capital. They don't have to pay tax on it until they decide to use the capital. So without boring everybody with the last layer, Mary and John sold the remaining 40% of their firm at $21 a share in 2022. We fast forward from 2017. So we stopped over $600,000 of capital gains tax on that transaction, and the children's trust grew by another $5 million. So remember, it was up to $7.8 million. Then when we evaluated their shares 5 years later, now the kids' trust is up to $12.8 million. Remember, mom and dad transferred that over a long time ago. And again, these kids' tax liabilities are being deferred or eliminated because mom and dad weren't afraid of gifting because they understood how to build the structure and not lose control. So basically, by gifting and the things that they did with the kids, it given them a tax exemption of about $750,000 out of the sale. And it's important to understand that Mary and John will owe tax on some of this capital, but they'll only owe it as they take it out. In some cases, we're able to help families pay 0% tax on their gains because we're able to keep their income below $81,000 adjusted gross married filing jointly. So we have some people selling $1 million properties with $800,000 of gain, and they're pulling it out slowly at a 0% tax, Ron, because we set up a corporate family structure, we followed a plan, and they get to control when they pay the tax.
Wow, it's pretty amazing when you think about these different scenarios, and some of it sounds really, really complex to me, Todd. I know that it's, I've talked to you many, many times about it, but when we come back, I want to throw some questions at you. If you've got questions, throw them in our chat, and I think that you'll find that it's not as complex as you think when you have the right leadership or the right guide. Right? It's like going on a trip. If you're trying to say, okay, I'm going from here to visit my friend Todd up there in Coeur d'Alene, and I get on the freeway, I'm in trouble because I might get on the 5 freeway, I might get on the southbound, I might get on northbound, maybe I'll get on the 91 or the 15 or the 10. I need a guide, right? So I need someone to tell me how to get there, how to accomplish these things. What we really just have shared with you this morning in these segments, and we're going to get into a little more of my questioning Todd when we come back, is there are ways to get out of debt without having to change your lifestyle radically by getting a good guide. There are ways to, defer or eliminate taxes by getting a good guide who can help you with that, who can show you tax strategies, taxes that maybe things that only rich and famous are using, because they're paying that guide. Well, we got a guide for you. We got a guy for that. You're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets.